So you're looking to buy a rental property here in Canada. Well, you've got to know your credit profile is a huge deal. I mean, it's the absolute foundation of your borrowing power, and it impacts pretty much everything, from your interest rate all the way to your ability to scale your portfolio. In this explainer, we're going to cover exactly how to position yourself as a strong, reliable borrower that lenders are going to love.
So here's the game plan. First up, we'll dive into why lenders care so much about your credit score in the first place. Then we'll unpack what that score is actually telling them about you. After that, we are going to break down the 5 key factors that make up your score. And finally, we'll get into some really practical strategies you can use to protect, maintain, or even improve your credit.
Okay, let's start with the big picture. Your credit score, it's way more than just a number. Think of it like your financial reputation. It tells a quick story about how you manage debt, and it gives lenders a snapshot of how trustworthy you are. A strong score can open up all kinds of doors to better opportunities, while a weak one, well, it could really hold you back.
And believe me, that one little number has a massive influence on your whole investment journey. It's going to determine how much you can borrow, which lenders will even talk to you, and what interest rate you'll end up getting. All of this hits your cash flow and your ability to scale your portfolio directly. You know, a lot of us were never really taught how credit works, so let's demystify it and make sure it's a tool that helps, not hurts, your success.
Okay, so here in Canada, your credit is tracked by 2 main bureaus, Equifax and TransUnion. What they do is collect all your financial information, your payment history, your credit balances, how long you've had credit, and from all that data, they generate what's called your Beacon score. And that number, that's the specific number lenders use to figure out their risk in lending money to you.
So, how is that all-important Beacon score even calculated? Well, it's not some big secret formula. It's actually based on an algorithm that weighs 5 key factors. Let's break them down one by one.
Okay, check this out. 2 factors carry most of the weight when it comes to your credit score. Payment history is the biggest piece of the pie, at a whopping 35%, followed really closely by credit utilization at 30%. The other 3, credit history, credit mix, and new credit, make up the rest. Just understanding this breakdown is going to help you focus your efforts where they'll have the biggest impact.
First up, payment history. This is the big one, making up 35% of your score. Every single late payment is like a black mark on your record, and even just one missed payment can have a pretty significant impact. Lenders are looking for consistency and reliability, so paying your bills on time every single time is absolutely crucial. Next up is credit utilization, and this makes up another 30% of your score. Now, this is just the percentage of your available credit that you're actually using. So, for example, if you have a $5,000 credit limit and a $1,000 balance, your utilization is 20%, which is great. The general rule is to try and keep it below 50%, and if you're planning to apply for a mortgage, definitely aim for under 30.
Now for credit history, which accounts for 15% of your score. This one's all about time. It just tracks how long your credit accounts had been active, and the longer, the better. This is exactly why you should almost never, ever close your oldest credit accounts, especially if they have a good repayment history. That long, stable track record builds a ton of trust with lenders.
Making up 10% of your score is your credit mix. Lenders really like to see that you can handle different types of credit responsibly. So a healthy mix might include what's called revolving credit, like credit cards, and also installment loans, like a car loan or a mortgage. This diversity shows that you're a well-rounded borrower. And the final 10% of your score is determined by new credit. Every time you apply for a new credit product, it triggers an inquiry on your report. Now, too many of these in a short period of time can be a bit of a red flag for lenders. Also, the type of credit you're applying for really matters. So the bottom line here is to be strategic and only apply for new credit when you really, really need it.
So, with all that in mind, what's the magic number we're aiming for as investors? Ideally, you really want to be aiming for a score above 680. Now, while anything over 670 is generally considered pretty good, crossing that 680 threshold often opens the door to better lenders and, more importantly, lower interest rates. And that can save you a serious amount of money over the life of a loan.
Okay, let's talk about a few common mistakes that can really hurt your credit score. First, carrying high balances, even if you pay on time. Remember that utilization factor we just talked about? Second, applying for a bunch of retail credit cards or loans from non-bank lenders. Third, you've got to be cautious about co-signing, because it can affect your own debt ratios. And finally, don't ignore those small debts. If they go to collections, they can do some serious damage.
So how do we build a robust report that lenders just love to see? We follow what I call the golden rule of 222.
It's simple. You want at least two forms of active credit, like a credit card and a line of credit. You want them to have been reporting to the credit bureau for at least 2 years, and finally, you want each of them to have a minimum limit of $2,000. If you can check all three of those boxes, you are well on your way.
But what if your credit has already taken a few hits? Hey, the good news is it's not permanent. You can absolutely repair your credit, and honestly, often faster than you might think. So let's get into some actionable strategies you can start using right away.
When it comes to paying off debt to improve that utilization score, there are two really popular methods. The snowball method has you pay off your smallest debt first. This gives you a quick win, and it really builds momentum and confidence. Then you've got the avalanche method, which has you prioritize the debt with the highest interest rate. This method will save you the most money in the long run. Whichever one you choose, the key is to have a structured plan and just stick with it.
All right, here is another super simple but incredibly powerful strategy. Automate your payments. Since late payments are so damaging to your score, the easiest way to prevent them is to just take human error out of the equation. Set up automatic payments for everything. Within about 12 months of consistent on-time payments, most people see a really meaningful improvement in their score. Consistency is everything.
Now, I want to leave you with this really important thought. You do not need a perfect 850 credit score to start investing in real estate. Good credit is truly good enough. You know, as a mortgage agent, I have access to dozens of lenders, and there's usually a solution for almost every profile. The key is just to understand where you stand right now and have a solid strategy to improve over time.
So, what's next on your journey? I've linked a free credit cheat sheet in the description with some handy tips and links for you. And if you found this useful, make sure to subscribe because in the next explainer, we're going to break down all the income requirements for financing a rental property. Let's keep building your investor edge together.